What's going on, everybody? It's Jeff here. Welcome back to the channel. A lot of whiplash the last 2 days. In this video, we are going to talk about something that is very important. There's been a narrative that has been spread that people are waiting for, talking about the Fed pivot, stocks rallying. Every time we've gotten some positive news from the Fed, there's been a short-term rally. I want to talk about the history behind what actually happens to the market when the Fed pivots. Okay. And when the market does eventually bottom and start to turn to the upside, we're going to take a look at some previous charts as well as some stats just to give you guys a breakdown. The reason why I want to make this video is yesterday we got another lower than expected CPI rating. We initially rallied only to sell off. It's literally the inverse of what happened in October when we bounced off that 350 to intraday rally up to be actually green that day. Same thing as yesterday, just the inverse. We bounced up to almost about that 414 level, came all the way down, touching 399 to finish the day somewhere around that 402 mark. Today, we got 50 basis points. However, you can see the market didn't rally. I want to cover some things, guys. So let's get right into it. First off, as you can see, a lot of whiplash up and down, and we're pretty much really just sideways from where we were around that 400, 401 level as we are about to close, okay? So like I said, yesterday, CPI came in at 7.1%. All right. It was expected to come in at 7.3%. A couple things to keep in mind here. All right. The way that the Federal Reserve calculates, okay, their CPI, and especially utilizing the year over year numbers, because inflation was already starting to run rampant around that November, December, January timeframe, prices are really going to have to continue to extend heavily and quickly, okay, in order to maintain that gap to be high. So it's unbeknownst to obviously inflation is going to decrease. So what I mean by that, just to give you a scenario before we move on from this topic, is last June, July, okay, the price of gas was say about $5 a gallon, right? All right. So if next June, July, gas is at $4 a gallon, that is a 20% decrease, negative 20%. That is going to really impact how high CPI is, or potentially how low CPI is. Okay. So because we're already running high in that November, December, January timeframe, the numbers are going to go down, even if prices continue to rise a little bit. It's all in their calculation. All right. So while 7.3, I did think was originally a little bit on the low side, it is no surprise we come in at 7.1%. Energy is leading to the downside, as well as shelter. Housing is starting to slow down a little bit, as well as rent increases. Now, today we got our 50 basis points. And I talked about that just a minute ago. We didn't see a rally. It was actually red from the beginning. If you look at this 15-minute candle right here, we kind of started to recover a little bit when Jerome Powell's, finished speaking, only to go right back to around that 400 level as we closed at 399.38, as you can see just a minute ago. A couple key takeaways from this. First of all, Jerome Powell had stated there is going to be no rate cuts in 2023. All right. Investors wanted to see a little bit of a pullback. Maybe they got to that 4.75 to 5%, which is what was originally being priced in. They pulled back a little bit. He, was really firm on him stating that there are going to be no rate cuts in 2023. Second thing that really stood out was where their terminal rate is going to be. Now, originally, like I said, investors were pricing in somewhere around that 4.75% to 5% Fed fund rate. All right. Now the dot plot shows anywhere between on the low end of 5.1% to 5.4%. So a little bit higher terminal, meaning, like I said, a little bit, and also that rates are going to stay around for a little bit longer. Okay. So those two things are the ones that really stood out. No rate cuts in 2023. Their Federal Reserve is actually pricing that it's going to be a little bit higher than that 5%, and it's going to stay a little bit longer. Now let's get into what I want to talk about in this video. Everybody's talking about this Fed pivot, okay? When the Fed pivots, the markets are just going to turn around, and history actually shows things to be a little bit different. Here's an article briefly explaining this. It's just, I read this article. I read a bunch of articles about this, okay, over the past few months. And this is one of the first ones that I came back about. So I'm going to bring it up to you guys. Fed pivot to lower interest rates will be bullish for stocks, but timing is everything. U.S. stock market typically doesn't bottom until after the Federal Reserve has already reduced their interest rates. Now, this article states somewhere around that 30 day time frame. Okay, 13 major pivots over the last 7 decades. Only 5 of them did the stock market bottom in advance of the move. Now, here's where things become a little bit different. Right now, they're talking about this pivot as when the Federal Reserve goes from either maintaining interest rates, okay, holding interest rates, or slowly rising interest rates to when they start to taper. We are going through something that is very extreme and very unique. We are rising interest rates at an insane pace, okay? So that does need to be taken, into consideration. The speed of which we are rising, the aggressiveness. All right, now the higher that we raise these interest rates, the faster that we raise these interest rates. When eventually that pivot does happen, that's where I'm focusing on. Listen, things are going to take some time to settle because the effects of these rates do not happen right away. They lag anywhere between 3 to 6 months, potentially 9 months for the economy to adjust to these rising interest rates. So while they have somewhere around this 30-day time frame, I'm thinking more about these between 3 and 9 months. Here is another chart, okay? And this shows the S&P index returns during the start of a Fed rate cut cycle. Now, this does show a few different scenarios. The couple that I want to focus on are going to be not only just 2001 and 2007 because the fact of the 12 months after it is red, but this is something that's a little bit more similar to what the Federal Reserve is doing, okay? Because we are in a bit of a crisis when you relate to what happened in 2001 and especially what happened in 2027. But it does show the vast difference, okay? In 89, 95, and 98, 12 months after they started their Fed rate cut cycle, the market rose anywhere between about 13% to 26% in 1998. They were still going through, the dot-com tech era, and some your tech side was running, very rampant during that time frame. So a little bit of difference there, but it is important noting. So anywhere between 13 and 26%. Then you look at 2001 and 2007, 12 months after the Federal Reserve started to cut rates, the market dropped an additional 17 to 24%. Okay. So you have two different sides of the spectrum here. The market can really pull even actually more points than it already has. The S&P can fall more points than it already has of where it's sitting from its high right now, okay, where it's fallen about 85, points. It can fall an additional, 85, 90 points on an extreme high side, okay, to potentially also rising another 85, 90 points. There's a massive, massive spectrum here, okay? So personally, I do believe that because we have raised these interest rates so fast, and because it does take time, all right, for the economy to adjust to them, the economy to really feel the effect of this, I do personally think that we're going to see an initial pop off, of when they do start that pivot. Now, I've also stated that there's going to be 3 phases of a pivot. Today was the first one. They have slowed how fast they are raising. The second one is going to be when they stop, and then the third one eventually is going to be when they cut. Now, if they do stop and pause for quite some time and the market does continue to pull hard, then eventually when they do cut, we might see a little bit different of a scenario. And obviously I'll be continuing to make videos and update you guys on that one. But if they stop, they pause, they keep it at, let's say, at 5.25% for a shorter period of time than what they're estimating as of right now, somewhere around that 2 to 3 month time frame, and then they pull, then I do think that we will see a little bit of a pull after the rate cut. It's all about how long they really hold that terminal rate for. Is it going to be 6, 9, 12 months? They stay all of 2023. How much is that going to bleed into 2024, and just where the economy is going to go? So I wanted to bring up this scenario because, like I said, I continue to see a lot of people saying, like, as soon as that pivot, it's just going to be like green light, and pump the brakes a little bit, guys. So that's it for this video, guys. I'll see you in the next one.